Every year for 55 years, Barron's has convened a group of top Wall Street investors and strategists to find out where they're putting their money. It's Barron's cover story this week. And joining me now, a longtime member of Barron's annual roundtable, Columbia Business School professor and retired Goldman Sachs partner, Abby Joseph Cohen. Thanks for coming on the show, Abby. I know you haven't been part of the roundtable for 55 years, but you've had a good long run with us.
A very long, multi-decade run, Jack, so I'm delighted to still be part of that group.
So this week's CPI print reinforced your optimism about 2023. You see core PCE inflation heading down to about 3% by the end of the year, and you think we can avoid recession. That almost sounds like the chimerical soft landing.
I do believe a soft landing is the most likely scenario. Of course, one can never rule out uglier alternatives. But what we're basically seeing is a very strong labor market, and that is something that will work as a very good offset to what the Fed decides to do. This is a Fed that is now facing inflation data still higher than they would like, but at least it's coming down. And that's something that is helpful. Let's keep in mind it's not only the Fed. We're seeing a decline in inflation in part as well because those supply chain problems, snafus, have eased up. And of course, there's been a big decline in global energy prices.
So that sounds to me like a pretty good backdrop for stocks, and you make that case.
I do believe it's a good backdrop, and we're starting 2023 with much better valuation than we did a year ago. Now, that is a polite way of saying that share prices fell dramatically, but clearly there are some very interesting opportunities right now in various parts of the market, and one could also argue that the fixed income markets are more attractive than they have been in several years.
Abby, this is Al Root. On the fixed income, how would you be thinking about allocating based on duration and the outlook for short-term rates? Where are some of the better values?
Well, if you had asked me this question in, let's call it a political vacuum, just looking at the arithmetic, I would say that there were some good opportunities in the short to intermediate side, and that we have seen a correction, if you will, that is prices moving in the right direction in terms of some things that are higher risk. A year ago, 6 months ago, investors basically weren't asking for extra yield for extending out along the yield curve and duration or extending out along the risk curve. Now that there's been some repricing, there's some opportunities. But if you ask me, there is still significant political risk right now in the fixed income markets, and it's coming mainly from domestic political polarization. I am very concerned when so many in the Republican side of the Congress are saying that they're willing to see the U.S. Treasury go into default.
Abby, Carlton English here. While you're speaking about risks, I'm curious if you can speak about some of the other geopolitical risks that we're seeing, such as, maybe China opening up, or the potential that China could even invade Taiwan, or even the ongoing war with Russia and Ukraine.
Those are some great questions and things to think about. With regard to the reopening of China, it works a couple of different ways. First of all, we are seeing very significant disruption in China right now because so many people are becoming ill. And there is the belief among global health experts that the death toll in China is dramatically higher than that government is indicating. In addition, there are some factories in some cities where there seems to be a shortage of available workers, primarily because of illness. However, ultimately, the assumption on the part of many investors is that the reopening of China will benefit the rest of the global economy as supply chains work through their snafus. And one important thing that you touched upon is whether China is feeling a little bit emboldened in terms of its dealings with Taiwan because of what happened with Russia, Ukraine. Mm-hmm. We have to be concerned about this as a global economy. If we add up, for example, the semiconductor production that comes out of Taiwan, which is the world's largest, with Chinese semiconductor production, the world's second largest, we are talking about 40 to 45% of global production. And so something that would disrupt that of course, would be problematic for everyone. But the eye is really on what might happen from a military perspective in that part of the world, and that could be troubling.
Yeah, and we're trying to ramp up chip production here, of course, but that's not going to happen in a few months. That's going to be a many-year process. Abby Joseph Cohen, thank you so much for coming on.